The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 20th of March, 2 weeks since we spoke, Jeremy, but welcome back. Good to speak to you again.
Hi, Gareth. Yeah, good to be here.
When we last spoke, the Iran war had started and seemed to be escalating into more of a regional conflict and was pretty worrying. The last fortnight really has just served to confirm those worries, and if anything, it seems to have accelerated. So I'd be interested to get your view on how markets have reacted and what might be the way forward or the various alternative ways forward.
Yeah. When we last spoke, we highlighted the fact that it was already escalating into a regional conflict, and it's a full-blown Middle East war now. Everyone is threatening to or actually hurling things at everybody else. The headline I saw overnight that Saudi Arabia is about to basically declare war on Iran, given Iran's current strategy. And we did talk about Karg Island being the focal point for Iran's energy. It handles 90% of its oil exports, the majority of which have been going to China. So Karg Island is the apex point of Iran's energy assets in the Gulf. Qatar, UAE, and Saudi and Iraq have critical energy infrastructure that are the wrong side of the Strait of Hormuz also. Yeah. And this is the point at which it feels like the US and Israeli initiated operation has gone out of control, because in previous spats in this region, broadly energy assets like Karg Island have been off the agenda. And we talked last time about how this could escalate. And unfortunately, that narrative has aged well and developed what I've termed a giant lobster pot for Trump, something that's much easier to enter than to leave. Meanwhile, I think as far as investors and financial markets are concerned, it's taking time for markets to adapt to this reality. And I think that's in no small part due to what happened last year following the imposition of tariffs, where we all know what happened next. And Trump did what Trump has become expected to do, which is to taco. However, it takes two to taco when you're engaged in a kinetic hot war. And yes, Iran has signaled they're not prepared to just reverse engines and pretend this didn't happen. Perhaps the decision to do this was based on a slightly hubristic response following the successes in Venezuela, which is a whole different problem to solve, to a country that's the size of Western Europe with 80 million inhabitants, a very hostile geography, and a regime that was set up 50 years ago with the strategic purpose of annihilating Israel and attacking the great Satan on the other side of the Atlantic. So the defanging of Iran is nothing like the operation in Caracas.
You're right, and they've been preparing for this for a very long time, and they've known through all of that their key strategic advantage is the Strait of Hormuz, so they'll have been doing everything they can to prepare for that and be ready for this eventuality.
Yes, and it's a subtle distinction to make, is that we're all saying, oh, well, the Straits of Hormuz have been closed. Well, technically not, because some traffic is going through. The Iranians are letting their own carriers go through. They're letting certain other people's carriers go through, notably those of Pakistan registered large crude carrier went through a couple of days ago. But I mean, this is a choke point that typically sees 30 or 40 very large carriers go through a day. And now it's literally not even a handful. But the principal deterrent is the huge cost if you lose one of these things and the insurance implications.
Of course, yeah.
But that doesn't mean that it's easy to open up, because every time you send a crude carrier through there, basically you're playing Russian roulette.
Yes, it is. And it's a situation where it's very difficult to see the off-ramp, but there are possible off-ramps. But in the meantime, how's the market been reacting? What's happened price-wise and in terms of financial markets?
Since we last spoke, Brent crude has traded between $90 and $115, spiked higher and lower than that intraday. Last time I saw it was about 107, so up 20% since we last spoke. LNG, which is obviously critical principally for Europe and the UK, European landed LNG has traded between 60 euros per megawatt hour and has traded between 45 and 67 euros in that period. But to put that into context, it was about 25, 26 euros back in January. So it's more than doubled. In the equity markets, the FTSE is down 4% since we last spoke, the 250 by 5% and AIM by 8%, the AIM 100. For comparative purposes, the S&P 500 is down 2% and the dollar is up. So the dollar has become the safe haven of choice. Equities have barely moved, particularly in dollar terms. And obviously, the higher the dollar goes, and it's sort of up 4 or 5% since the bomb started falling in Iran, the more pain the US is able to export to the rest of the world. So the equity market is still saying this operation won't last very long, i.e., it's only going to last another few weeks.
Right. And so it's been a generally risk-off reaction, but in terms of the safe haven asset, that's been the dollar rather than gold or Bitcoin or whatever else. That strengthening the dollar means that the inflationary aspects fall disproportionately on other countries than the US. So ironically benefiting Donald Trump in terms of the financial impact of what's going on.
Yeah, but politically, this is critically petrol prices or, pumped gas prices in the States is crucifying the MAGA movement right now.
Okay.
Still in the sort of financial domain, bond yields are rising and central banks are squealing, basically. The 10-year US dollar Treasury benchmark yield is up a couple of basis points. But in the UK, the equivalent gilt benchmark is up 3.5 basis points. And Japan 10-year is now up a basis point to best part of 2.3%. In all this, Australia has actually raised rates and signalling it will raise rates further because of the impact of higher energy costs. So central banks are fearing, and their worst fears look like they might come true because basically we're having a return to the 1970s.
So it feels like there's a difference in reaction between the bond markets and central banks and the equity markets then. Is there a risk the equity market isn't reflecting the dangers that the other markets, particularly the bond market, appear to be already pricing in?
Yeah, and I think all these things operate on pieces of elastic that stretch a bit and then can break. The edifice of the bond market is all around long-term inflationary expectations, although, bonds, they still haven't reacted as if there's a huge strategic crisis here. If bond investors felt that long-term inflation expectations had gone from 2.5% to 5%, then 10-year yields would be heading for double digits right here.
Okay.
And if we're talking about a return to the 1970s, it's worth bearing in mind in 1975, the US 10-year bond yield was 15, 16%, and it's now less than 5. So this whole return to the 1970s, stagflation is the issue. And the question is, what can policymakers do about it?
So what can policymakers do about it? What do you think the options are?
The question is, are higher energy costs inflationary or deflationary? And the answer is both, but over different timeframes. So in the short term, the cost of you filling up your car, let's say it's 50 quid, and it goes to 75 quid the next time you fill it up. You go, that's not very good. But you wouldn't change your habits. But if it went from 50 quid to 150 quid or 300 quid.
Yeah, I might visit the in-laws a bit less frequently. Yes, that's true. Yeah.
You would drive less often. You'd fill up the car with other people. You'd carpool. And I think it's worth bearing in mind that people who are saying, well, the oil price is going to $200 or $250. Well, the world economy comes to a halt at about 150, I would reckon, or somewhere between 150 and $200. Demand just gets destroyed.
Demand's not completely inelastic, no, especially over time. Yeah.
Yeah. So it becomes deflationary, and not for a good reason, because economies collapse. So what's the policy response from an economic collapse? Well, you reduce interest rates. So this is the dilemma of the central bank. because it's reaction function to rising inflationary pressures of the cost of going up, 30%, 50% of you filling up your car, is to raise rates.
Yeah.
Which adds further pressure on the economy. And ultimately, it becomes deflationary. And your ultimate policy response is to cut rates sharply and to engage in some form of quantitative easing.
We've heard these stories before, haven't we?
Yes.
I guess the question is whether central banks have learned from previous missteps. That'll be the real question, right? To see how they behave.
Well, the ultimate endgame in the 1970s was that a guy called Paul Volcker came along and took short-term US policy rates to 20%, killed the world economy. But that is not a policy option that is really on the table for central banks, or more importantly, for treasuries this time round, because we're so heavily indebted, and taking rates much above the current level calls into question the financial viability of the US Treasury, for example.
I see, yes. I mean, one conversation we haven't been having in the last 3 or 4 weeks relates to the independence of the US Fed, which hasn't gone away as an issue, but just hasn't been discussed, I guess.
Well, I think it was interesting that in the decision by the Fed to leave rates on hold this week, in the press conference, Jay Powell made reference to the fact that he wasn't going to leave office until the resolution of the current investigation into his behaviour by the Department of Justice. So he is engaging in overt political language in a way that he hasn't before. And I think this whole fiscal dominance, independence of the Federal Reserve and ultimately other central banks are going to be called further and further into question the longer this goes on.
Okay, so that's some interesting views on where the medium and long term might be. What about the next few weeks? Where do you think we might go from here?
I think it all depends on this key question of how long does this last? The bulls will tell you this is a Berlin Wall moment for the Middle East, and that the ultimate defanging of Iran, successful operations would be hugely beneficial, not just to energy prices, but to the world economy, and the stability of the Middle East would be delivered in a way that none of us have seen in our lifetimes. The other end of the spectrum is that this is America's Suez crisis, and you've got China in the background, who will ultimately become the major beneficiary of a US forced retreat from this theatre of war, if you like. In the short term, I think that this period of engagement goes on for several more weeks. And over that period, the risk is for higher energy prices rather than lower energy prices. And I think for that piece of elastic to other financial markets, particularly equities, is to lead to lower equity valuations, higher bond yields, and more volatile FX markets. And then a further spike upwards in the dollar makes life more painful, particularly for emerging markets. And for that, I would probably broadly encompass the whole of Europe these days.
Sadly so.
I think more confusion around policy responses as central bankers and politicians just look more than ever like rabbits staring into the headlights of an oncoming car here, because they just don't know which way to move, because they know ultimately they've got to move both ways at once.
Yeah. To be fair, we have seen central banks move together, in lockstep globally. I remember during COVID, there was some very impressive coordination of activity across the world. And if they could achieve a similar sort of working together, that might be a good sign, but who knows?
And I think to that point, there does seem to be signs of coordinated ambitions, at least, if not actions, from Japan, Europe, the UK, Australia, exerting their influence on the US and Israel and Iran to just calm things down and try and reopen the straits to get the oil flowing again. You could easily see oil prices, I don't know, if we talk in another 2 weeks' time, 20% lower or 20% higher than here. And I think really that sums it up. You made a reference to Bitcoin earlier in our conversation. Now, Bitcoin's actually gone up in all this in dollar terms. So when the oil price has been more volatile and looks like it will remain more volatile than Bitcoin in the coming weeks, then we are in interesting times.
We are indeed. Absolutely. Interesting and in many ways worrying. But yeah, let's leave it another couple of weeks. We'll come back and see what's happening in the world in the meantime. But no, great to get your insights again, as ever, Jeremy, and we'll speak in a fortnight.
Okay.
Talk to you then.
Look forward to it.
Thanks a lot.
Brought to you by Progressive Equity.